Good afternoon, everyone, and welcome to the Q3 2025 edition of the Blackfinch AIM in Focus webinar. We're pleased you can join us today. For those of you who are new, my name is Josh, and I'm the product specialist for our listed investment solutions here at Blackfinch. And I'm joined today by Lawrence Campin, Senior Investment Manager at Blackfinch AIM. So, before we begin, it's important to note that the content of this webinar is intended for the professional advisory community, and so the details covered today are not intended to be taken as financial advice itself. Or when we mention single stocks, these aren't to be seen as recommendations. They're merely examples of companies in the context of a well-diversified portfolio. As always, if you'd like to submit a question prior to the webinar for us to discuss, please use the contact information contained in the sign-up page or simply email eventswebinars@blackfinch.com. Now, I'm sure we can all agree that the first 2 quarters of the year have been nothing but eventful, not only for the AIM market, but also global investment markets. And we've seen investors try to adjust to a new Trump agenda, with President Donald Trump announcing a tariff regime unlike anything the world has seen since the 1930s. Some geopolitical tensions in the Middle East causing volatility, and also strong moves in currency markets, with the US dollar significantly falling in value and creating catalysts for investors using the likes of sterling or the euro or yen. Amid all of this news, the AIM market has in fact shown good returns over the quarter, and we believe still has significant upside potential on offer for investors, and we're going to explore why in just a moment. And once we've covered that, I'll pass the baton over to Lawrence, who's going to dig into the thickets of our portfolios and talk to some of our investee companies on what's going on. And from there, and as I mentioned on the first bullet point, all of these events are now starting to highlight some interesting investment trends and themes that Lawrence will discuss. So what I want to do is use the chart on show for the AIM market and talk to this quarter's events and use it as a bit of a timeline. Now, as we know, there's almost too much content to pack into a short space of time. But if we look on the left-hand side of this chart, the start of the quarter saw Trump announce his radical Liberation Day tariff regime on the 2nd of April, and that directly correlates with the drawdown we can see in the AIM market on the left-hand side. And these really were much harsher than expected and were country-specific reciprocal tariffs on nations with trade surpluses against the US and most notably China. And although AIM is a UK market, many of its constituents trade overseas, where their revenues may come from multiple countries. So this naturally can be swept up in the tariff fever and the unfolding uncertainty from businesses on capex and future commitments. And this was a sharp drawdown, but in relative terms, the AIM market from peak to trough actually had less downside capture than something like your S&P 500, because at the time, the general consensus was that these tariffs are going to create more pain for domestic US companies via higher costs. But also, as we know, the AIM market's been in a bear market for some time now, and many valuations are at compelling lows. So this almost acts as a bit of a floor for investors in comparison. But what's important is that dashed blue line on the screen. And that's the announcement of the pause on reciprocal tariffs, so countries could negotiate better terms with the US. And slowly and surely over the quarter, optimism returned back to markets. And this pause really was the start of a wider trend, which is now known as TOCO, meaning Trump always chickens out. Because as we know, Trump, he slowly walked back on his tariffs and has almost made investors now look past tariff threats. And I'm skipping ahead, but we've seen Trump make threats in Q3 already on the likes of a 40% tariff on Europe and certain emerging markets. But markets continue to climb, and generally that is also the case for the AIM market. And it does talk to the investor's psyche at the moment, where they're looking past these threats and almost acting like business as usual. And if we follow the line and look into May, the UK and US struck an economic prosperity deal, which rolled back a small number of tariffs, including reducing tariffs on US imports of cars from the UK and the elimination of tariffs on US imports of steel from the UK. And it does provide some relief to the UK car and steel industries, but the agreement doesn't really tackle the wider issue of that broad 10% levy applied to most UK exports under the regime. So looking forward, There are still UK businesses that could continue to face elevated costs or logistical uncertainty, albeit at a lesser extent to some of the regions like the EU. And I know Lawrence will talk to themes emerging from recent events in just a moment, but as we know, I think one of the most pressing topics in the UK is the upcoming autumn budget, and this really does present a key moment for investor sentiment. We've already seen how high the political stakes are from snapshots in the House of Commons, and from an economic standpoint, public finances really are under pressure. There's still uncertainty around tax policy and capital gains treatment, and this could cause shorter term volatility. So until we have that clarity, AIM is likely to remain sensitive to shifting expectations, although we expect the downside risk may be countered by valuations remaining low and takeover activity continuing, like we can see on that left-hand side of the chart. So with that in mind, Lawrence, good afternoon. I'll hand over to you at this point.
Thank you, Josh, and good afternoon, everyone. So today I'll be covering two investee companies that have reported on trading recently. So I'll then look to cover the themes that we are seeing in the market before passing back to Josh for the wrap-up. So looking into the first company I would like to cover is MHA, which had an initial public offering in April, which we participated in across both the growth and income portfolios. So MHA is a UK-based top 15 accountancy firm with expertise in areas including audit and assurance, tax compliance, business advisory, and wealth management. So a key part of the rationale of the listing was to help facilitate continued growth, both organically but also through acquisition. So pleasingly in May, less than 1 month post-listing, the company announced a proposed acquisition of a fellow Baker Tilly member firm. So the deal diversifies revenue into new geographies, including Cyprus and Greece, and is in our view a very sensible step forward in the company's growth journey, with the ultimate goal of growing revenues to 500 million over the medium term. So trading update followed later on in June, with MHA confirming that trading in the second half financial year had been strong, with good demand seen in all divisions, with results for the full year expected to be slightly ahead of expectations, with revenue up 45% to £224 million. Moving on to the Property Franchise Group, this is the UK's largest multi-brand lettings estate agency, franchising group, and holding in the income portfolio. And they reported full year results in April. So the results were in line with expectations, with revenue up 6% on a like-for-like basis, with 52% coming from recurring sources. So the company has roughly doubled in size over the last 18 months, firstly through the merger with Belvoir, a similar sized lettings agency with expertise in financial services, and latterly through the acquisition of GPEA, which brought two further leading real estate brands into the group, and also an element of membership and licensing fees. So integration of these businesses into the group is ongoing and expected to yield material cost and operational synergies. So the Property Franchise Group is also taking a proactive stance on the upcoming Renters' Rights Bill through weekly sessions held to help educate landlords on the changes to the legislation. So the business is well placed to help these self-managed landlords, either through taking on the management of their properties and tenants, or through helping to facilitate a sale to another landlord in the network. So the business has confirmed the first quarter of the current financial year was in line with expectations, and we think they are very well placed to continue growing organically and achieving the final synergies from the acquisitions. Moving on to some of the themes in the market, we firstly have noticed that takeover activity has continued at pace, and this does help reinforce our view that despite an improved performance in Q2, companies remain very attractively priced. However, what was good to see in Q2 was multiple companies defend against incoming bids, so citing the opportune nature of the approaches and belief in the future performance and return opportunities for shareholders. An example of this is Craneware, a leading value cycle software solution provider to the US healthcare industry and an investee company in the growth portfolio. So Craneware noted in May that Bain Capital, a global private equity firm, was assessing a possible offer. Approximately 1 month later, Bain Capital announced it was no longer considering making an offer, but Craneware confirmed it had rejected a proposal which valued the company at £26.50 per share, which was around a 30% premium to the price at the time. So pleasingly, the company confirmed recent trading had been strong, with the highly recurring revenue base accelerating. So our take on this is that while takeover approaches in AIM have been providing some immediate upside, there is always a question mark over whether they are the best outcome for shareholders. In the case of Craneware, founder-managed business with strong insider ownership, we also believe the proposed £26.50 bid was at a discount to the intrinsic value of the business. So we expect Craneware is well placed to continue expanding with existing customers, which make up around 40% of all US hospitals and associated pharmacies, and utilize their market-leading data sets, which cover over 200 million patient encounters, to provide increasingly valuable insights. The news flows on companies carrying out cost-cutting and efficiency initiatives has also continued. So usually this is off the back of some tough end market conditions. However, we are also seeing management teams tighten the belt, even when they are experiencing positive trading momentum. Now, an example of this is Quartix, the subscription-based vehicle tracking company and an investee company in the income portfolio. So since the founder, Andy Walters, returned to the company as executive chairman in October 2023, the business has really refocused its efforts on growing the subscription base across its geographies. So pleasingly, this has so far been well executed, and along with the implementation of contractual price rises, has driven the company to report ahead of expectations multiple times this year. Now, Quartix announced shortly after quarter end that it has actioned a reorganization of the internal software teams, which, along with other cost initiatives, is expected to result in a meaningful £0.5 million reduced run rate in overheads. So generally, we do encourage management teams to perform a continuous review of their cost bases, regardless of their market conditions, to ensure they are well placed to move forward. Now, the final theme I want to note is the high volume of RNS notifications we see daily that relate to companies repurchasing their own shares. So often these share repurchases are made to negate the dilution impacts from vesting employee share options. However, we are increasingly seeing companies repurchase in excess of this amount. So providing these share repurchases are made from spare cash resources and for prices below intrinsic values, we support management teams actioning buybacks. Now, should valuations re-rate over the medium term, we expect there could be material upside from share repurchases at the current price. So with that, I will hand back to Josh for the wrap-up. Thank you.
Thank you, Lawrence. Some great insights there. And I'm sure we can all agree it's nice to see some positive trends coming back to AIM, and long may it continue. So that's everything for the July 2025 AIM in Focus webinar today. So thank you, Lawrence, for joining us today, and all of you tuning in. I hope you've all got some nuggets to take away to your client meetings off the back of today's content. And as always, should you have any questions off the back of the content, feel free to contact your dedicated business development manager. We'll ensure we get back to you. And the next webinar will be held on the third Thursday of every new quarter, meaning the next is Thursday, 16th of October at the same time of 1 p.m. And we look forward to seeing you there. And bye for now.